Ah, dear students, do we have a treat for you today? Well, maybe not. As we said in the previous presentation, investors know that they're getting charged, that the mutual fund company is not a non-for-profit organization, and that they are paying for their services. But they don't really understand how it works. And many people might say that that is by design, that the mutual fund industry has done its best to hide the fees. Well, that might be a little harsh, but there's a little bit of truth to it. However, unlike the banking industry and the life insurance industry, because of the Investment Company Act of 1940, mutual fund companies are required to tell you in the prospectus what they are charging you. However, they make it so that you can't understand what they're doing, how they're charging you. But you are going to understand it because you are going to be the investment gurus for your friends, for your families, for your coworkers. And so I'm going to get you, I'm going to show it to you, and I'm going to hold you to it. And these will be on the exam. And we want you to learn them because you're going to look like a genius. You really are. If you understand this, people are going to be amazed and be overwhelmed and be very proud of you. And so will I. So let's start on slide 21. Every mutual fund has what is called annual operating expenses. Doesn't matter what type of mutual fund it is, there are annual operating expenses. And they're normally broken down into three categories. The management fees are typically the most expensive, but not always. And this is the fee that is paid to the portfolio managers, the research analysts, the folks with the top hats who make the investment decisions. And folks, excuse me, if they're doing it right, it ain't a cheap operation. It's a very expensive operation because there's tremendous research involved. It involves, if they're doing it right, going all over the world, really, because companies are no longer, there's some that are based here in the United States that just do business in the United States, but most of the large companies in the United States have operations all around the world. And then, of course, if you have a global fund, you've got to go around the world to see where those companies are based, but they have operations here. So if it's done well, it is not cheap. It's a very expensive, time-consuming, and research-intensive occupation. The second category is the 12B1 fees. 12B1, what a dumb name. Well, yeah, I apologize, but these are the fees that are used to defray advertising, servicing, and distribution costs of the fund. Up to 1% per year of whatever you have in the fund. You mean mutual fund companies are required by law to show you what they're paying for advertising? Yeah, that's part of the Investment Company Act of 1940. Does Coca-Cola or Tide or Nike have to tell you how much they're paying the superstars in the stupid bowl for advertising? No, but the mutual fund company does. And then the third category is the catch-all phrase. That's the accounting and other expenses. Those are the website, right? The transactions, the keep the lights on, the rent. And that's usually the smallest portion. Now, this fourth category on the slide really should have its own slide, really, but I didn't want to create a whole slide for the trustee fee. If you have a Roth IRA or other type of retirement account, what the IRS calls a tax qualified account, then you have to have a trustee to hold on to your money. Don't worry, it's your money. They're not going to run away with it. But the IRS requires that a trustee be holding the money. And so, that's you got to pay these people, and they typically charge $10 a year. I've seen it upwards of $30 a year. Most companies don't even tell you this anymore. They just take the $10 out. Older companies will let you pay the $10 with a check outside the investment, and then you get to deduct it off of your investment expenses. But most people don't. It's $10. Big deal. Okay, so those are the annual operating expenses that every mutual fund must pay. What about on slide 22, trading costs? Well, trading costs are not disclosed in the annual perspective. You don't know what the trading costs are. So how does an investor know how much the trading costs are? They're basically rolled into the cost of the investments and the cost when they pay the investment and then when they sell the investment. So how does an investor know? Well, you can ask the mutual fund, and they'll go, huh? Because nobody asks us. It'll take them a long time to find the right person who knows. Oh, yeah, he wants it. Oh, yeah, well, you have to talk to George. He'll know. Or basically, don't bother. Just look at the annual turnover. The annual turnover is a very important number, and I'm going to ask you to research that in the assignment, because that's a measure of how much trading a mutual fund does. And it's measured in percentage of the amount a portfolio turns over every year. So obviously, the higher the turnover, the more they're trading, the more the trading costs are. If it's 100% turnover, that means that they hold the average stock, bond, whatever they're investing in, 1 year. If it's 50% turnover, they hold it for 2 years. Does it make sense, right? 100% turnover, everything's gone in 1 year. 50% turnover, that means half of it's gone after 1 year and the other half's gone. If it's 200% turnover, and some of them are, they're not mutual funds. I mean, they're not the mutual funds that I'm interested in. They're short-term investors. Then they're holding an average of 6 months. What I look for, and that's me, is about 20-25% or lower. It depends. Some mutual funds, just by their nature, trade more often. Money market mutual funds trade all the time, so you can't look at their turnover. But some mutual funds trade a lot more than others. But you're looking for 20-25%. And why is that? Well, we're going to look into that much later on when we get into stock valuation and the like, because that means they're holding it for 4 years. 3, 4, 5 years, 20%, 33% would be 3 years. And why is 3, 4, 5 years a good holding period? Well, as we said, we'll discuss that later on when we see how to peer into the future and assign a valuation to a stock or a bond. Okay? So, suffice to say, the higher the turnover, the higher the trading costs, the more the mutual fund is trading instead of investing. Are you an investor or are you a speculator/trader? Slide 23. Now, there's the endless debate, the eternal struggle, the eternal debate of whether you should buy a load fund or a no-load fund. Well, when the mutual fund industry started, there were only load funds because they were only sold via distributors, via salespeople, stockbrokers, financial representatives, and the sales load was charged to compensate the financial representative. Well, through the years, companies decided that they were going to bypass the financial representative and create no-load funds, where there's no representative. You go right directly to the mutual fund company, so they don't charge a commission. And you'll hear people say you should never buy a load fund. No-load funds are always cheaper. Well, that's not necessarily true. If the no-load fund has very high annual operating expenses, it could wind up costing you more than the load fund. So wipe that off your plate. But if you believe you don't need the help of a financial representative, certainly you're not going to look into buying a load fund, unless you find the fund that you find is the best fund you find is a load fund. Then you got to go through the financial representative. Does that make any sense? We'll take a look at some in a bit. Slide 24. Because the financial representatives are not stupid, and they saw these no load funds eating into their business, they decided to get creative and start diversifying from the traditional front end load, and created an explosion of what are called share classes. And this is what I'm going to press you on, folks. I'm going to ask you these things. So make sure you're taking notes or studying, because it's important. The first mutual funds had what is still called a front end load. Class A, they are now called. Sometimes they're called Class 1, very infrequently. It's normally Class A. The commission is paid when the shares are purchased, and they normally have lower annual operating expenses than their siblings. But people don't want to pay that upfront fee. They don't like that. So the mutual fund industry, in their wisdom, came up with Class B. And the way to think of this is back-end load B, Class B. They charge you on the way out. Wait a minute. What difference does it make? You charge me up front, you charge me in the back. No. Relax, booby. Sit down. Relax. You see, the Class B shares start out with what is called a contingent deferred sales charge, which isn't that a great name? Contingent deferred sales charge. I love that word, contingent. Say it. It feels good when you say it. Your throat vibrates. Contingent deferred sales charge. And it might start out at 5% or 4%. But then the second year it goes down to 4, 3, 2, 1. You see, it declines to 0 over a period of 3 to 5 years, 6 years, depends. Every mutual fund's different. So you understand what's going on here? Yeah, we're trying to get you to hold on to the fund. We don't want you to pull the money out within a year or two. And so we're going to hit you with a contingent deferred sales charge if you do. If you hold it for 4 years or 6 years, depending on, every mutual fund's different, then you won't pay any sales charge. Well, what's the catch? Well, these B shares normally have higher annual operating expenses until the contingent deferred sales charge declines to 0, and then they revert to Class A shares, which have lower annual operating expenses. So the idea is, folks, we don't want you moving your money around. Mutual funds are long-term investments. Put it in and leave it in. Okay. It makes sense. Slide number 20. Where are we? I'm sorry, 25, right? 25, I'm sorry. No load Class C. You see, people didn't want to pay the upfront fee. They didn't want to pay the back-end fee. So the brokerage firms came up with these broker no-load funds. Well, they're not allowed to be called no-load funds anymore. They used to call them broker no-load funds, but they're not allowed. They have to be called load fund. Well, they don't have an upfront fee. They don't have a back-end fee. Well, they might hit you with a 1% fee if you take the money out within 1 year, but you don't want to do that. It's a long-term investment. The Class C shares normally have higher operating expenses in perpetuity. It's a fancy way of saying a long time. Or, forever. Perpetuity really means forever. Or for 10 years or whatever, using those 12B1 fees that we're going to see. So they can wind up costing you more than the Class A or the Class B shares, even though there's no upfront fee and there's no back-end fee, as long as you don't take it out within a year. You wind up paying more than the Class A or the Class B shares. And the Securities and Exchange Commission got into the act and said, look, brokers, you can't call these things no load if the 12B1 fee is greater than 0.25%. Huh? Right? You see, what they did is they snuck the load over 8, 9, 10 or more years into the 12B1 fee. They amortized it, which is a fancy way of saying they spread it out. So the Securities and Exchange Commission said, no. You can't call these things broker no-load funds. You must call them load funds, even though you're really not charging a load. You're charging the commission, if you will, over 10 years or whatever. Are you confused yet? Good. We've done our job. Slide number 26. So the brokerage firms, they're not going to take that lying down. They created another class called Class F, or sometimes called Class I, or sometimes called Class FI. It goes by various names. But these are the financial investment advisor, investment advisor shares. And they're sometimes called advisor no-load funds, because they truly are a no-load fund. There's no upfront fee, there's no back-end fee, and there's no there's maybe a small 12B1 fee, maybe no 12B1 fee. Sometimes they just get rid of the 12B1 fee. And what do? They put these in what is called a wrap account, or sometimes called a managed account or a wealth management account. And what the advisor does is they charge an extra upwards of 2% every year just to manage the account. Wait a minute, the advisor's not doing anything. The mutual fund investment in professionals are doing the work. What's the advisor doing? Just sitting there looking at the mutual fund saying, well, looks okay to me. And so the brokerage firms are all pushing this, because if you're a broker, you would love to get 1 or 2% of your client's money every year in perpetuity, as opposed to just 5% or 3% up front. Yeah, no, folks, I want to tell you right now, I don't have any clients that do this. I would tell them that it's not in their best interest. I wouldn't want to do this myself, and I don't want to have any clients do this. I mean, I would tell, as a broker, I would make more money doing this, but I don't think it's in your best interest. And I try to act as a fiduciary. I want to do what's in the best interest of the client, not what's in the best interest of the advisor. Oh, but advisor loves these things, folks. Advisors love these things, and they get angry at me when I say this. Luckily they're not listening to this. They already know it all. They don't have to listen to these presentations of Business 121, Introduction to Investments. They already know it all, which is good for me, because if they heard it, they'd be angry at me. And I do my best not to play my hand when I'm with other advisors. And one guy was charging 2%, and I thought, that's a lot. I didn't say anything. I said, well, I don't know. I just think I forget how I said it, but he goes, what are you talking about? You send them a bottle of wine on their birthday. You take them out golfing every once in a while, take them to a steak dinner. They're going to love you. And I thought, oh, my Lord, that is just not what you want. I mean, what can I say? This is, this is what you're up against, dear students. I'm not trying to say that all advisors like that. Most of them aren't. But that's what's going on in the industry. Another little story about a client who went to a certain church, and the people at church wanted her to put their money with them, and they had this wealth management account. And I explained to her that they were going to take 2% a year from her money to manage the account, which basically meant they weren't going to do anything. They were just going to take 2% a year. And she was a little concerned. She went and told them what I explained to them, and they lowered it just like that to 1%. And she went with them because they were good Christians at her church. Okay. Another little story. A student came up to me from a very wealthy family in Los Angeles. He was here, but his family's in L.A., and they don't understand they don't understand how they're being charged. He showed me the portfolio, 12 pages of something or other, but no, it wasn't that many. It was big. That was big, and it was $12 million a portfolio, and they were getting charged 1% a year, which is by Wells Fargo advisors or whatever. And on the very last page was the fee, which was paid monthly. And folks, 1% of $12 million is $120,000 a year. So I showed him a fee of over 10 grand. And I said, do you understand that you're being charged $10,000 a month just for these people to watch over your investments? And his mouth fell open. I said, does anybody in your family understand that? He goes, oh, I don't think so. I'm pretty sure not. I said, well, you'll go tell them, right? He goes, yeah, I'll go tell them. I don't know whatever happened, but so this is what's out there, folks. This is what's out there. And then lastly, the true no-load funds on slide 26. Now, wait a minute. That's not what they're really called. That's not a legal term. But that's what the people in the financial journalism world call them. They call them true no-load funds. They have no upfront fee, no back-end fee, no 12B1 fee greater than 0.25%, and no wealth management fee. Make sense? Yeah. And these companies deal directly with the public. Bypass the middleman. Who needs a financial advisor? Well, the truth is, a lot of people do. I know it might sound self-serving because I happen to be one, but I will tell you, dear students, that people make incredibly stupid mistakes, the rookiest of all mistakes, by buying high when the market is screaming and everybody's partying. Ooh, is it too late to get in? And selling low when the market tanks, as it invariably does. Ooh, is it too late to get out? And at the end of chapter 4, in the very last presentation, we're going to see how it plays out in the general public. So, in my humble opinion, many people, not everyone, certainly not you, dear students, because you're taking the time to learn and not panic and not be all goo-goo-eyed when the market excites on the upside, and not be ready to throw yourself off the bridge when the market goes down. So you may decide that I'm going to be my own financial advisor. Cool. Plus, if you're in a 403b, 401k, the financial advisors don't really want to help you. They don't even want to. They'll talk to you, but they got more important things to do, like fleecing others. Servicing other clients. However, those true no-load funds may not have lower annual operating expenses than some load funds. So you have to be careful. They could wind up costing you more than a load fund over time. You must look at those annual operating expenses, because there are some true no-load funds with very high annual operating expenses, especially smaller ones, upwards of 2% a year, that's $2 for every $100 you have in the account, as we shall see momentarily. Slide number 37, as in right now. Here is our first example. This is a real mutual fund, folks. It's a very, very successful mutual fund. It's called AMCAP. Kind of a silly name, AMCAP. Stands for American Capitalization or something, and it's been around since 1967. Right? So it's a pretty old fund, and it's a very successful fund. By the way, one of the gentlemen who was one of the original people who ran the fund moved from this fund in the early 80s, started his own company called PrimeCap, AMCAP, PrimeCap, and then worked for Vanguard for many years. In fact, PrimeCap still works with Vanguard. But he passed away in 2012, and his obituary, or a link to his obituary, is on the Chapter 4 section of the class website. Howard Scowl was his name. A very interesting gentleman. So if you're at all interested in these people, and there's a few stories about others on the class website too. So let's take a look at AMCAP. Notice that they have 4 class shares. They actually have a hell of a lot more, but we're just going to deal with the main ones. A, B, C, and then the F. They have F1, F2, and F3. So let's take a look at F2. The Class A shares have an upfront fee of 5.75%. What does that mean? Well, that means you put $50 in, they're going to take $2.88 out. And that goes to, some of it goes to the mutual fund, some of it goes to, the rest of it goes to the brokerage firm that you're dealing with, and then the brokerage firm splits the commission with the broker somehow, just 50-50 or whatever split. If you put in $100, that would be $5.75. If you put in $1,000, you're getting this is $57.50. $10,000, $575. $100,000, well, no. Actually, what happens once you hit a certain break point, the percentage goes down. That's why it says here maximum sales charge. This is right out of the prospectus, by the way, which is legally required to be given to the investor, but it's no longer given in paper form. They just say, click here to say that you've read the prospectus. And of course, everyone's read the prospectus. So the sales charge starts at 5.75% but goes down. And we'll see that later on. We're going to see that as we move on in the presentation. Now, these three, you don't normally see these too often. The maximum sales on reinvested dividends, redemption on exchange fees. You don't normally see that. That's not normally there. The maximum deferred sales charge, we'll see that in Class B and Class C shares. Now, the management fees, those are very important, right? Those are the amount, that's the amount of money that's being paid to the folks with the top hats. Every year, these people are getting 31 cents for every $100 you have in the account. That's what 0.31% means. And most people don't understand that. They see that number and they go, I don't know what that means. But for every $100 you have in the account, they're going to take 31 cents. And they're also going to take 23 cents to service and market and distribute the fund. Plus 13 cents for the accounting and the website and the rent and the lights and the utilities and the like. So you're looking at 67 cents every year. For every $100 you have in the account, they're going to take 67 cents. Now, does that sound like a lot of money? It's actually on the low side. It's on the lower side of mutual funds, as we'll see. Some are lower, but for actively managed funds, and we'll discuss the difference between actively managed and passively managed in a little bit, it's actually on the low side. How much do you think that bank is taking every year? Or that life insurance company? Well, it's a hell of a lot more than 67 cents, I'll tell you. And if you ask them, they'll just go, huh? What? We don't have to tell you. We don't even know ourselves. They're not going to tell you. They're not required. The mutual fund is required because of the Investment Company Act of 1940. And so they put it in the prospectus in a way that most people can't understand unless it's explained to them. And then they go, okay. And then they forget. Now, you go to your broker and you say, well, Ms. Broker, I really don't want to pay that upfront fee. And she says, no problem. Right. For you, we have Class B shares. Sit down. Let's have coffee. There's no upfront fee. And there's a maximum deferred sales charge of 5%. What does that mean, Ms. Well, that means the first year we're going to hit you with a 5% fee. Okay. But then relax. The second year, it's 4, 3, 2, 1. And then after 6 years, you're not going to pay any sales charge. You're in it for the long term. Aren't you, Mr. and Mrs. John Q. Investment Public? Oh, yes, Miss Broker. Yes, we're in it for the long term. So you're not going to get hit with that maximum deferred sales charge as long as you hold the funds for 6 years. All right. I feel better now. The management fees are still the same, 31 cents for every $100. But what happened here? It went from 23 cents to $1. The 12B1 fees went from 23 cents in the Class A shares up to $1 in the Class B shares. What's going on? Well, they still had to pay the financial representative a sales commission. So what they're doing is they're sneaking that sales commission into the 12B1 fees and paying it out over time. Does that make sense? I hope so. Because that's how it works. And then the other expenses are 12 cents. So now we've gone from 67 cents for the Class A shares to $1.43 in the Class B shares. We're still nowhere near close to what the banks and the life insurance companies are charging now. So you go to your broker, I don't want that upfront fee. I don't want that back end fee. Maybe I'll take the money out within a couple of years. And she says, you know what she's going to say, no problem. Here come the Class C shares. No upfront fee, no back end fee. Well, we're going to take 1% if you take the money out within a year. But really, folks, you shouldn't do it. If you buy a mutual fund, you should hold it for at least a few years, not just 6 months or so. I mean, in my humble opinion, you decide. It's your money. But if you take the money out within 1 year, they're going to hit you with a 1% sales charge. So don't do it. The management fees are the same, 31 cents, but there's the 12B1 fees, $1. Yeah. And that in this company stays there for 10 years, right? Yeah, this mutual fund company holds you to that dollar for 10 years. 17 cents for the other expenses, so now we're at $1.48. Ugh, that's even higher than the Class B shares. So you go to your broker. I don't want to pay upfront fee, Ms. Broker. I don't want to pay a back end fee, and I want low annual operating expenses. And she says, no problem. You get you know how the industry works now, right? There's never any problem. We're gonna take care of you. Okay. No upfront fee, no back end fee, low annual operating expenses. Look, 31 cents for management fees and zilch, 0 for the 12B1 fees. 16 cents for other expenses, 47 cents, 0.47%. The lowest so far. What have you got to lose? Sign right here. Oh, by the way, we're going to charge you an extra 1 or 2%. What was that, Ms. Broker? We're going to charge you an extra 1 or 2% every year for a wealth management fee. Do you think a lot of people who are paying this? Well, I told you that one family, they didn't know they were paying that wealth management fee. They ever $10,000 a month. Yeah. So what do you think of AMCAP, huh? What do you think? Well, it's been a very good fund for its investors over the 40 years it's been around. Cool. So let's now take a look at another. This is the AB. It used to be called Alliance. Then it was called Alliance Bernstein. Now it's called AB. Remember Alliance from the previous presentation? The company that had 2 people involved in the shenanigans and gotten in big trouble. Yeah, it's sad. But 2 people can ruin it for an entire company. But it survived, and now it's called AB. I still call it Alliance. And they've got some great funds, and this is one of them. It's called the Large Cap Growth Fund, and this fund has been on fire. Notice that the Class A shares have an upfront fee of 4.25%. So right off the bat, they're a little cheaper than the previous company, right? You see, remember the other company was 5.75%. So there's a bit of a little incentive there. Hey, it's cheaper. But wait a minute. The management fees are 74 cents. That's more. That's twice as much as the other company. The distribution fees are basically the same, 7.25%. The other expense is 17%. So whereas the other company, AMCAP, was charging 67 cents a year, this company's charging $1.16. So sure, they have a lower upfront fee for the Class A shares, but they charge you more in perpetuity, meaning forever. The Class B shares have a lower maximum deferred sales charge of only 4%, But again, the management fees are higher, 74 cents. The distribution fees are $1, just like the other company. 21 cents, $1.96, almost $2. Now we're getting close to what the banks and the life insurance companies. We're not there yet, folks. But we're getting closer to what the banks and the life insurance companies are charging you for every year, or for every year for your money, holding on to your money. Now, what about the Class C shares? Again, they charge you an upfront fee of 1% if you take the money out within a year, which you're not going to do. You're going to hold on to it. 74 cents for the management fees, $1 for the 12B1 fees, 18 cents for the other expenses, $1.92. Yeah, $1.92 a year. That's a lot, folks. That's a 1.92% per year is pretty high fees. What does it mean? Well, think about it. If you're trying to match the market, say the market does 10%, you have to do almost 12% just to break even. Just to make 10%, you've got to make 12 for your clients. You've got to make 12% because you're taking 2% of the money. Yeah, you understand now. Now you're starting to understand how these fees can really eat into people's returns, and why the mutual fund companies are incentivized, at least the more reputable ones, to keep the fees as low as possible. Now, they used to be called the F class. They don't call them anymore that. They call it the advisor class now. Make it sound more appealing, more prominent and established and well-heeled, so they can charge you 1 or 2% a year on top of what they're charging you. No upfront fee, no back-end fee, 74 cents, same. The managers are getting paid the same no matter what. No 12B1 fees, 18 cents, so 92 cents, plus tack on another 1 or 2%. Yeah. But this is a good fund, folks. I'm not trying to badmouth them. Just watch out for those fees. Slide 29. Now here is a very famous, infamous, no-load mutual. What happened? This company used to not have A, C, and all the other shares. They had what they called the primary shares. And when the Securities and Exchange Commission issued that edict that says you can't have a no-load fund that has a 12B1 fee greater than 0.25%, they said, all right, we can't call it a no-load fund anymore, so we'll just switch to Class C shares. And then they added the Class A shares. They didn't even used to have the Class A shares. They're relatively new. So they do the same as the AMCAP, 5.75%, but their fees are higher, right? 68 cents, 25 cents, 9 cents, $1.02. Here are the old guard fee shares. As we said, they used to be called primary class. Now they're called Class C. No upfront fee, almost 1% if you take the money out within a year, but you're not going to do that, folks. Don't do that. 68 cents, same to the managers. Almost $1, a little bit less than $1. 12 cents, so $1.75. $1.75 for the primary shares. Now the financial advisor, financial investment advisor, FI, that's what FI stands for, financial investment advisor. Same idea here. No upfront fee, no back-end fee, but 68 cents, 25 cents, 18, $1.11, plus add on the 1 or 2% that the advisor's adding on. So yeah, that's not great. And then what are these institutional? What do you have to be in an institution to get these things? Well, yeah, as a matter of fact, you have to be an institution. You have to have a lot of money and not be a retail investor, and we'll come back and take a look at those later on. So why do I show you the Legg Mason Value Trust? Well, it's actually called Clearbridge Value Trust now. I still call it Legg Mason Value Trust. I'm going to show you later on how low the mighty can fall. And the mighty used to be the Legg Mason Value Trust, and then they fell. So this is an example of one that was famous and then infamous. And now for something completely different. What is that? Well, the previous 3 funds, folks, were actively managed funds. What does that mean? That means that they have managers that go around and knock on the doors of Ford and GM and Toyota and Honda and BMW, if they're automotive research analysts, and they decide what company to buy. They say, yeah, we're going to buy Ford and GM. We're not going to buy Toyota. We're not going to buy BMW. They're the investment advisors. They're the portfolio managers, the research analysts. But these index funds are passively managed, which means all they do is look at a list of stocks. And one of the most famous lists is called the Standard & Poor's 500. And we're going to take a look at this in detail in Chapter 5, but we're going to use it in Chapter 4. So that's one of the problems of doing mutual funds before we get to stocks. The Standard & Poor's 500 is the list of the 500 largest companies in the United States. Well, it's a little tweaked a little, but that's the idea. 500 largest companies in the United States. So if you're a mutual fund manager and you are running a passively managed fund that happens to have the Standard & Poor's 500 as its index, all you do is you run down the list of the 500 stocks in the S&P 500, and if they're on the list, you buy them, and if they're not on the list, you don't buy them. It's that simple. So you see the people in the top hats, they ain't doing nothing, folks. They're sitting around looking at a list of stocks. You or I could run this fund. Not that we'll ever get a chance to, but we could do it because it's an index. It's just a list of stocks. And why? Well, there are some reasons behind this. As we said, it's expensive to do the research, and it eats into your returns. So if you don't have to do the research, you can charge your investors a whole lot less. How much less? Let's take a look on slide number 30. No upfront fee, no back-end fee, 14 cents. How low can you go? It's like limbo. Right, because they're not doing anything, folks. They better not charge a whole lot. The distribution and service fees are relegated to a $20 annual fee if your account value is less than 10 grand. So if they call it a low balance fee. But if you sign up for electronic delivery of financial statements and the like, just like at your bank, they'll waive, W-A-I-V-E, they will forego that $20 annual fee. The other expenses are 2%. So we're looking at 16 cents. 16 cents, far lower than anything else that we've seen, but it had better be far lower because they are not doing any research. And that's the reason index funds are normally cheaper. Normally. Hang on a minute. We'll get back to that in a bit. Vanguard was one of the first to do indexing. They weren't the only ones, but they certainly made it very, very popular and have become extremely successful. In fact, they're the world's largest mutual fund company now. Slide number 31, Fidelity used to be the world's largest mutual fund company. And Vanguard, with their indexing, became larger. And so what did Fidelity do? They eliminated all sales loads, created their own index funds, and lowered their fees lower than Vanguard. Limbo. So now, Fidelity, it used to be called the Spartan Index. Isn't that cute? Spartan, Spartan. I don't know if people understood that, but the Spartans were sparse. They were abstemious. You like that word? That's a good word. Abstemious. It means, cheap. They didn't believe in. You didn't get a blanket. You just slept on the bed without a blanket. And so, but they changed the name. I guess people didn't get the Spartan part. So no sales charge, no deferred sales charge, management fees of 1.5 cents. What? Yeah. Forget 14 cents. We're going down to 1.5 cents. They have a low balance fee, which again they waive if you get sign up for automatic purchases. And then 7.5 cents for other expenses, so 9 cents. So what was 17? Now we're down to 9. I'm sorry, 16 down to 9. So you see, competition. How low can you go? Whew. And that's not the lowest, folks. Now, what we are required to do is, in the prospectus, is show you how much it costs you over 1, 3, 5, and 10 years. So let's take a look at that AB Large Cap Growth Fund. And I don't know why the Securities and Exchange Commission uses $10,000, as if $10,000, everyone's got $10,000 lying around the house. But if you put $10,000 away, what's it going to cost you in fees over 1, 3, 5, and 10 years? Well, it makes sense. If you're paying that upfront fee of 4.25%, 4.25%, it's $425 right off the bat when you buy the fund. The first year, the A shares are a whole lot more expensive than the B or the C shares, right? The third year, the B and the C shares are catching up. The fifth year, they've basically all caught up. And then after 10 years, the B and the C shares actually wind up costing you more money than the A shares. You see? The F shares look like the best deal, right? Don't forget the typical fee of 1 to 2% per year. That would add another $1,200, another $2,400 to the total cost. So over the long term, if you believe that a financial advisor is best for you, it makes sense to do the A shares, folks, if you're in it for the long term. Yeah, certainly. That is what I tell my clients. I say, look, the A shares are the best deal over the long term. You want to pay more? I can charge you more. I don't want to. In fact, if you sign up for the B, the C, or the F shares, the advisor class shares, you have to sign something. You have to sign an acknowledgement saying that you have been advised that you're going to wind up paying more over the long term than if you just paid the upfront fee. Again, do you think most people understand what there's? I don't think they do. I don't have any clients that do this, so I've never had anybody who had to sign it, thankfully. I always leave that spot blank. But I don't want to sound too holier than thou, because remember, I get paid from Southwestern Community College, thank you very much. And I'm not worried about making my rent payment and all the other things by getting some kind of commission this month. Whereas if you're working off commission, maybe it's a little different. You have a different perspective. Slide number 33. Same thing is true for the Legg Mason Value Trust. The A shares over time wind up being the better deal than the C shares. And of course, the F shares, remember, they're going to be more expensive because of the typical advisor's fee of $1,200 to $2,400. Now, what's going on with these institutional class shares? Well, as we said, to get them, you have to be a large pension fund, you have to be a university endowment, a tax-exempt charity, and they usually want you to have at least $1 million to invest. Yeah, see, it's a different world when you have a lot of money. In fact, I'm sorry, we'll get back to that in a bit. So when you have a lot of money, they treat you a whole lot differently. You're big. 34. Now, let's go back and take a look at that index fund, because the fees for actively managed funds will almost always be less. For passively, I said that wrong. I apologize. Whoa, back up, rewind the tape. The fees for passively managed index funds will almost always be less than actively managed funds. Now, look, there's a little star there if you're watching the presentation. Careful. In some 401k plans, they will sneak high fee index funds into the 401k plan. Why? Why would you do that to your clients? Because you can. Who would do that? Southwestern Community College. For years, we had these we had these individuals who had snuck in these high-priced index funds. They were index funds. They did the exact same thing that all index funds did. They looked at a list of stocks and they bought it. Looked at a list of bonds, they bought it. But they had high fees. Why? Because they were giving a kickback to the brokers. The brokers were getting a kickback, a remuneration, because they were selling these high-fee index funds. And I would explain it to everybody who listened to me at the college, and I would complain to our human resources department, and they didn't understand. And finally, one of the women there said, "Well, I'm going to take your class." She took my class, and she said, "I understand now. I understand. You were getting ripped." Well, thankfully, they got rid of them last year. What was it? Yeah, a year ago. They got rid of them. So we now have low-fee index funds, which is what we should have. And notice that Vanguard has remember Fidelity went below Vanguard? Well, Vanguard's not going to stay there. Right, exactly. They created another class below their regular index 500 fund called the Admiral class. And you used to have at least $100,000 to get into the Admiral class, but now you only need 10 grand. And remember we talked about the exchange traded funds? Right, they have even lower fees. Why? Because they're not doing anything. Not only are they not worried about buying what they have to buy, the brokerage firms are the ones that are keeping track of who buys and sells the ETFs. So you don't even have to keep track of your clients. The brokerage firm does it for you. So again, it is limbo. How low can you go? Okay, so now let's get back to that idea of how much money do you have. Because if you have a lot of money, they're going to treat you really well, dear students. Remember we said the maximum sales charge was 5.75%? 5.75% for AMCAP. But as soon as you either purchase or accumulate, see it says either purchase or accumulate, $25,000, it goes down to 5%. 50,000, 4.5. 100,000, 3.5. 250, 2.5. 2%, 1.5. Until finally, when you either purchase or have accumulated $1 million, you pay no sales charge. You see, they love high net worth individuals. They love institutions with lots of money. So if you're very, very wealthy, you get treated really a whole lot better than people who are putting $50 a month away. I got to tell you the truth. Some brokers would fail to inform their clients of this feature. Instead, as the client approaches the breakpoint, the broker would advise them to start another fund with a different company. Now, when I first heard this, I could not believe it. I simply could not believe it. It just seemed too fantastic. Because, you're going to fool some of your clients, but you're not going to fool everybody. Somebody's going to figure out that you've screwed them, for want of a better term, and you're going to get a reputation. But hey, they got away with it, I guess, for a while. And it turns out now, if you do this, the SEC is looking after you. If you do this, you as the financial advisor can get fined and have to pay back the clients the amount that they had to pay overage. Plus, you can lose your license. So the SEC has come down on this technique. But I just can't. Enough said. Because we got more time. Let's keep going. Slide number 36. And then we discussed the contingent deferred sales charge. Here we're getting back to the AB Large Cap Growth Fund. The first year you put the money in, if you take it out, they're going to hit you with a 4% sales charge. which you're not going to do, folks. You buy a mutual fund, you leave it in there for for at least 4 years, and then 3, 2, 1. So after 4 years, the Class B contingent deferred back-end sales charge is gone. Some are 6. I've never seen any more than 6. But in the life insurance industry, life insurance companies usually have this type of what they call surrender charge schedule. However, they don't start at 4 or 5 or 6%, 5%, 4%. They start at 25%. And it takes you 20 years to go down to zero. So those surrender charges, as they call them, they don't call them contingent deferred sales charges. They call them surrender charges. Those are very, very high. Yeah. Okay. So now, are you tired? I'm exhausted. I don't know about you, but I'm exhausted. So now that you know everything you need to know, well, actually for the exam, but you really don't, because there's other share classes out there, folks. We didn't even get into the retirement share classes, but there are others out there, educational share classes. They're out there, but they basically all work the same idea. Some have upfront fees, some have back-end fees, some charge you more every year. Same idea, different variations on a theme. Now that you know about the A, B, C, and the F shares, and the true no-load shares, which would you choose? I'm going to give you 10 grand. How's that? $10,000. What a deal. 10 years ago, would you pick the AMCAP fund? Class A, of course, because the Class A shares are going to be the cheapest. Would you pick the AB Large Cap Growth Fund? Used to be called Alliance Large Cap Growth Fund. Class A. Would you pick the Legg Mason Value Trust primary shares, because they didn't have the Class A shares then, and they don't really push the Class A shares. Class C is their bailiwick. Or would you pick the abstemious, there's that word again, Vanguard Index 500? And just see if you can match the index. All right, you decide. You decide. Now, if you printed this out and are looking at it printed out, it's not going to magically disappear, but if you're following along in this presentation, the blue box or purple box, whatever color it is going to go away, and we're going to see that. Ta-da! Wow. Hey, we didn't do too badly if we picked AB, right? Even though they had higher annual operating expenses, they returned 9.04%. And your $10,000 became almost $24,000. On fire. There's a great fund. On fire. AMCAP did okay. They beat the Index 500, not by much. Remember, you had to pay that 5.75%. So they have a hefty upfront fee. But they have lower annual operating expenses. Ew. What happened with the Legg Mason Value Trust? Ugh. Well, we're going to take a look at Bill Miller in one of the later chapters when we take a look at all stars of investing. Bill Miller ran the Legg Mason Value Trust for many years, and he put up eye-popping returns. In fact, if you had seen this thing 10 years ago, that $11,500, 1.41% annual return over the last 10 years, would have been $34,000. He was hammered by the 2008 recession, just destroyed. And he limped along until about 2012 or so when he finally retired. And now it's run by a couple other folks. And they're trying their best. But boy, he left a legacy. The Index 500, didn't do as well as the Standard & Poor's 500 Index. Well, it can't, because it has that small fee that it has to pay. It's not going to match the index, but it's going to get pretty darn close. Fees are important, dear students, but they certainly do not tell you the whole story. When comparing mutual funds, you must look at many attributes, not the least of which are the rates of return, preferably over longer periods of time. And note at the bottom that if you had that $1 million to invest and picked AMCAP or the AB Large Cap Fund, you would have done even better because, you wouldn't have to pay the upfront fee. So those average annual returns are at the bottom what we call net asset value. Remember from the previous presentation, without sales charge. But that's only for people with $1 million to invest. Okay, slide 38. Ready for checking for comprehension. I'm going to ask you, folks, I want you to know, I want you to burn this in the back of your eyelids. These shares do not have an upfront sales load. Instead, they assess a decreasing back-end load if you withdraw your money within 6 years. The annual operating expense is higher, courtesy of the 12B1 fees. Decreasing back-end load, contingent deferred back-end load, right, B shares. They normally eventually revert to the A shares after 6, 8 years or so, depending on the company. Slide 39. These shares do not have an upfront fee and only a 1% back-end fee if redeemed within 1 year. The advisor called them no load, but you notice that the annual operating expense is higher than other share classes, again, courtesy of those ubiquitous 12B1 fees. You like that word, ubiquitous? It means ever-present. Yes, what are these? A shares, B shares, C shares, F or I? Right, these are the C shares, right. No upfront fee, a 1% back-end fee if you take them out within 1 year, but you have the higher annual operating expenses. And then they sometimes revert to A shares or F shares after 10 or more years. Yeah, depending on the company. Now, last slide. Slide number 40. Your advisor tells you that these shares have no sales fee, no back-end fee, no upfront fee, no 12B1 fee, very low annual operating expenses, and she mumbles something about wealth management. Are these shares A, B, C, F, or I? Yeah, right, you know what shares these are. These are the F shares, the I shares, FI, financial advisor shares, financial investment advisor shares. She also did her best not to explain that her brokerage firm will charge you an extra 2% each year, but they'll send you a bottle of wine on your birthday and take you golfing, and so you'll be happy. What do you think? Go back. I know it's confusing. I apologize. It's not my fault. I didn't design the system, but I apologize on behalf of the industry. But we want you to know this. And why? Why? Because here is where the shining, brilliant light will come upon you, and all of your coworkers will just bow to you, because you'll be in that meeting where the guy with the 3-piece suit is trying to tell you how wonderful the 401k plan is and how they've got all these great funds in there. And you're going to be reading the prospectus and going, what is this index fund with 74 cents per $100? Why aren't you giving us a Vanguard or a Fidelity index fund with 7 cents for every $100? And he is going to turn beet red, and he'll recover somehow because he's got to make his BMW payment. But you are going to look like a genius, and your coworkers are going to think you are the best. And then they're going to say, "Where did you learn that?" And what are you going to tell them? Right, you're going to tell them, "I learned that in Business 123, Introduction to Investments at Southwestern Community College. So see, I washed your back, you washed my back." Okay, now, yes, go back, make sure you understand A, B, C, F, and I shares, the contingent deferred sales charge, the sales charge breakpoints, and then we're ready for our next presentation, because in the next presentation, dear students, it gets even harder. We're going to try to put our arms around this industry. It's like trying to put your arms around an 800-pound gorilla, 800-pound marshmallow, but we're going to do it. So make sure you've digested everything about fees, because next presentation we try to take a look at all the different types, or no, not all the different types, just the major types of mutual funds. Thank you for your excellent effort and attention. You're doing great. I'm so proud of you, and we'll see you in our next presentation.